Introduction. Definition of the Federal Reserve System. It is the central bank of the United States. It was established in 1913 through the Federal Reserve Act. Its main objective is to keep the U.S. economy stable and secure. History of formation. After the Panic of 1907, Congress felt the need for a central banking system to prevent such crises. This led to the creation of the Federal Reserve System. Structure. Board of Governors, located in Washington, D.C. It consists of 7 members appointed by the President of the United States. The position of chairman is the most important. Federal Open Market Committee, FOMC. This is the main body responsible for making monetary policy decisions. It has 12 members. 7 governors, the president of the New York Federal Reserve Bank, and 4 other Reserve Bank presidents who serve on a rotating basis. 12 Federal Reserve Banks. The U.S. is divided into 12 districts, each with its own Federal Reserve Bank. These banks provide local economic information to the Board of Governors. Roles and objectives. Conducting monetary policy, the most important function of the Fed. Its goal is to maintain full employment and stable prices. Open market operations. The Fed buys or sells government securities. Buying securities increases money in banks and lowers interest rates. Selling them reduces money supply and raises interest rates. Reserve requirements. The amount of funds that banks must hold with the Fed. Changes in reserve requirements affect banks' lending capacity. Discount rate. The interest rate at which banks can borrow from the Fed. By raising or lowering it, the Fed can tighten or loosen monetary policy. Financial system stability. Another key goal of the Fed is to maintain stability in the financial system. It supervises banks and other financial institutions. Bankers Bank. The Fed provides services to commercial banks. It issues and manages currency and coins. Government's Bank. The Fed acts as a banker for the U.S. government. It manages government spending and treasury securities. Consumer protection. The Fed enforces consumer protection laws to safeguard the interests of consumers. Tarah. Independence and accountability. Fed's independence. To keep it free from political pressure, the Fed is designed as an independent institution. Members of the Board of Governors serve 14-year terms, protecting them from political influence. Accountability. Although independent, the Fed is accountable to Congress. The chairman testifies before Congress twice a year on monetary policy. Criticism and controversy. Lack of transparency. Some believe that Fed decisions are not transparent enough. Impact of monetary policy. Fed's policies may increase inequality in the economy. Political pressure. Despite its independence, the Fed occasionally faces political pressure. Conclusion. The Federal Reserve System is a cornerstone of the U.S. economy. Its policies deeply influence both the national and global economy. Its main objectives are stability, employment, and financial security.